Hello and welcome to Options in Plain English. Today we're going to be talking about the last one of the basic option strategies. We've already talked about buying calls, buying puts, selling puts, and today we're going to talk about selling calls. To start with, we're going to look at a comparison to something we already know, which is the long call. So buying a call is on the top and selling a call short or shorting a call is on the bottom. So as you can see, they are very similar strategies, only one is the opposite of the other one. So let's analyze them. A long call position is bullish, whereas a short call position is bearish. That's the main difference. And it might be obvious, but it's worth stating again. A long call has limited risk and unlimited profitability. You can only lose what you pay for initially when you put the position on. And you can make, theoretically, a very high amount of money because the stock could basically go to an infinite value, theoretically. There is no limit on how high a stock can go. On the other hand, a short call has unlimited risk and limited profitability. Why? Because you can only make what the credit that you initially get, and you can lose infinitely because the stock could go very, very high, theoretically, to an infinite value. This is something similar to what short sellers experience. When they sell short, they can only make the max profit that they can make is from the price to zero, because the stock cannot go lower than zero, but it could go arbitrarily high. So it is said that the loss is theoretically unlimited or infinite. It could be infinite. Another difference is the buying power reduction for a long call is the cost of the call. Whereas for a short call, the buying power reduction is obtained by using the BPR formula, and it can only be done in a margin account. So this is another difference. You can buy a call. If you have the cash, you can buy a call pretty much on any account that you have, a cash account, a margin account, with any approval level, but not in the case of a short call. So as we can see here, if you want to sell a call in a cash account, it's not even allowed, and in a margin account, you need to have the highest approval level to be able to sell a call. Why? Because theoretically, remember, the risk is unlimited, and your brokerage firm is not going to be willing to be on the hook for potentially unlimited losses if you get caught in a bad situation where you have, for example, a short call where the stock goes very high. That's why it's only once you've proven to the broker that you can handle tough situations and heavy losses, and that you have the funds to cover them, that you are given approval to sell calls. Now, once you've been given approval, what is the BPR going to be for any call that you want to short? Well, the formula is a very similar formula to the one we use for puts, which is the highest of the 20% of the stock minus the amount that it is out of the money buy plus the option value, or 10% of the market value of the position, so where the price of the stock is, plus the option value, or $50 per contract plus the option value. This is for stocks that have a very low price. So basically, the highest of these three values is going to be the buying power reduction for your short call. Now, we're going to go through the process of analyzing the actual details of selling a call. So if you have a short call, what that means is you have a call, you sell it at a strike price K for a certain credit, then your break even is going to be equal to the strike price. Here I'm analyzing a call that was sold and that is out of the money, because here is where the price is, where the price of the underlying is. But it applies to in the money options and also at the money options and also out of the money options. So the break even is going to be the strike price plus the price of the call, or the credit that you received for the call, is going to be right over here. The max profit for this position is the credit that you got. So when you sell it, you get a credit. That's your max profit, which is right here. This is a bearish position, but it doesn't matter how low it goes. You can only make the credit that you got. The max loss, we were saying, is unlimited. So if it starts going higher, it's going to get to the break-even point. And if it goes beyond that, then at expiration, you can have an unlimited loss. Now, if we start doing an example here, you're going to see that this is very similar to selling a put. The only real difference is that there is no limit on how high a stock price can go. So this is the only limit, and it makes a difference because now you don't have a predetermined max loss that you can have. So for example, let's say that there's a stock that's trading at $200, which is right here. Okay, right here. And then we sell the $220 call for a credit of $12. So we got $12. That money goes immediately into our account, and the position is now going to have a break-even point of $232. And that's pretty much all you need to know about the call. You have the price here. You sell the call. You get $12. This is your break-even. This is the max profit that you can make, and you're going to start losing money as the stock goes higher until you hit the break-even point. If it goes beyond that, then you're going to lose money at expiration. Now notice here the dashed line, which represents the time passing. So time passing with no price movement is beneficial to this strategy. If we just sell the call and the stock doesn't move and stays here as time passes, this is the dash line, is going to start here. It's going to start going higher and higher. It's going to start making money for you, and it's going to come to a point where your price target or your profit target is probably going to be reached, and at that point you can just close it by executing a buy to close transaction. So you open it with a sell to open, and you close it with a buy to close transaction. So as you can see, time passing with no price movement is beneficial to this strategy, and something similar happens when we talk about implied volatility. If we put on the position and implied volatility starts going lower, then it's something similar as if time was passing. So implied volatility and time passing, or time to expiration being reduced, has the same effect on the position, on a short option position. Okay, so this dash line is going to start approaching the expiration line, the solid one, and at a certain point at expiration is going to reach it. And at expiration, if it expires out of the money or at the money, so if it expires at this point or below, you're going to get the full profit. So you're going to keep the whole credit that you got initially. If it expires in the money, then you're going to get assigned. Now, assignment for a short call is similar but different, pretty much the opposite of a sold or a short put. When you're assigned on a short call position, you're going to be selling the underlying at the strike price. So if you had the stock already and you can cover it, then it's going to be called away. So you're going to be forced to sell at the strike price. And remember, you already kept the credit that you got. So you need to include that in your calculations. If you don't have the stock and you sold a call, then you're going to become short the stock because there is no short for you to deliver. So you become short. So whether you made money or not, you're going to have to calculate. For example, if it expires at 226, you're $6 in the money. Okay, so you sell at 220. You can buy it back if you didn't have the stock and you became short. You can buy it back right away at 226. So you lose these $6, but you got 12 in your credit. So all in all, net, you're going to have a profit in this position. So you have to be aware of all the credits you've been collecting. And if you start rolling and adjusting your position, you're going to have to keep track of all of them to determine whether you've made money or lost money on this particular position. Alternatively, you could also keep the short position, and if you have the margin and you have the funds to keep your position, then you can just go on with and carry on with with this position in your portfolio. It's up to you. But the important thing to understand here is if it expires in the money, you're not going to exercise. You're going to be the counterpart to that. So you're going to be assigned, and you're going to be assigned a short position. Now, in real life, the short call is frequently used even by beginning investors as part of a covered call strategy, which means selling calls while owning the underlying stock. So, for example, if I have 100 shares of a certain stock, I could sell an out of the money call, and at that point, if the price doesn't move, I collect the credit and I keep my stock. If it goes higher, I profit all the way until it hits the strike, so all the way to here in this example. And then at expiration, I'm going to be forced to sell at this price, but I already have the stock, so there is no further problem for me because I'm just going to lose my stock. It's going to be called away from me. So this is a strategy that is very, very often used. So this is one of the uses of a short call. So not as an outright way to short the market or to benefit from downward movement or downward price movement, but also to put on a position called a cover call, which simulates getting a sort of a dividend out of your existing position in case you don't get enough price appreciation. Now we're going to go to the trading platform to take a look at this position and analyze it and see what happens. So now we're going to go to our trading platform, and what we're going to do is I've already pre-selected a stock, and that's Johnson & Johnson. There is no particular reason to select this one. I just picked one at random. Johnson & Johnson, ticker symbol JNJ. And what we're going to do is we're going to have an opportunity here to put on a short call position. We're not going to deal with puts this time. We're going to look at calls. I've already opened up the June expiration with 52 days to go. You have the delta here, so now you know where it is. And what I'm going to do first is I'm going to switch to my cash account to try to sell a call in my cash account. Okay. So what I'm going to do is I'm going to stocks trading at 152. I'm going to sell the 160 call, which is the 27 delta call. Okay. So it's I'm selling one of the J&J call, the $160 strike price for June at 188. So a single contract's going to bring me $188 worth of credit. Okay. So before I send it, you're going to see that it's not going to let me. Why? Why is it illegal right here, as it says right here? It doesn't let me because this is a cash account. So I can't sell a call in a cash account. So I have to switch. So I'm going to switch to my margin account. And now we're going to do the exact same, but now we're going to do it in a margin account. I've been already pre-approved. So you can see now it's going to let it through. And let's take a look here. So I'm selling one J&J call, the 160 in June for 188. Max profit 188. Max loss infinite. This is what we're talking about. The it's unlimited risk. Okay. The buying power effect. I'm not going to go through the formula, but you can tell 16,000 would be the actual. Actually, no. 15,000, because we're talking about the value of the market value of the stock. So 152 times 100, so $15,000. And for this trade, my broker is taking around 2.2K, so $2,200 in buying power effect. So that's going to be my buying power reduction, my BPR. It's around 20% of the value of the market value of the full stock. So this is a good rule of thumb. If you are approved to sell calls, it's just around 20% of the total position. So you have to multiply it by 100 shares per contract. So if you are shorting one contract, one call, then you would have 100 shares of the stock price at that point. And then 20% of that roughly is going to be what you're going to be using as part of your buying power. So your buying power is going to be reduced, and when you close the position, you're going to get it back. Okay, so let's analyze what happens here. And this is what we were showing you. This is the stock price at 152. The strike price, the call that we're selling, is the 160. I'm just gonna go to June, because this is the one that we are this shaded area, this gray area, the one with a lighter color. This represents a 1 standard deviation move for the stock. So this is pretty much what's expected, what the stock's expected to move. So as you can see here, we're selling the 27 delta call. So the stock can go higher and higher and higher, all the way to 160, and then 161.88, or right now 161.92. It just changed. And this is going to be the break-even point. And if it expires, at that point, at that point or lower, you're gonna make money. If it expires below your strike price, you're gonna keep the full profit. And if it starts going down, what's gonna happen is you're probably not gonna have to wait too much, because then as you can see the purple line, your profits are gonna come much sooner. So you're not gonna have to wait until expiration. So nothing happening, going down, going a little bit higher, and you'll profit on this position. And like I was saying, if, for example, implied volatility starts going down, which is what I'm gonna simulate here, look at the purple line, your profits are gonna start coming in, and they're gonna start accruing. And if there's a huge volatility decline, then you're going to start getting your profits. So this is pretty much the position we talked about. Now, if we go back to our trading page, so now what I'm going to show you is how the cover call position that we discussed works here. So in this platform, the cover call is already predetermined as one of the strategies. So I just selected here, buy cover stock, and as you can see here, I'm going to be buying 100 shares and selling one call, the 160 call. So instead of paying $152 for the stock, I'm going to be paying $150.21. So in essence, I'm getting the stock at a discount. Why? Because I'm getting the credit for the short call right away. Now, what is the flip side to this? The flip side to this is that anything beyond 160, I'm not going to profit from my stock because I'm going to be obligated to sell at 160. So, in exchange for that potential future gains, for those potential future gains, I'm getting credit right now. Now, those gains might never materialize. So, if the stock price stays right here, well, you profit, you get the credit for the short call, and you never have to sell anyone, and you keep the stock. So this is a strategy that's used a lot, like I was mentioning, even by beginning investors, because it's a way to get a little bit of yield out of your position if that position doesn't go through price appreciation. It's like a pseudo dividend. So that's another use for the short call, other than outright being bearish on that underlying. So I hope this was clear, and I hope that this is going to be useful for you. Now we've looked at all four basic strategies: long a put, long a call, short a put, short a call. And from now on, what we're going to do is we're going to start combining them, and combining them even with also with long stock and short stock, so that you have all the different strategies, and you can customize your strategy to what to exactly what you think about your underlying and what your underlying is going to do. So now you're going to start seeing the power of options and how customizable they are and how much flexibility they afford you. Thank you very much for your attention, and goodbye.